Madhuri Das, the director of the Institute, distinguished guests, and my young friends. It's always a very tough call to speak to young people. It is very tough for two reasons. One, they belong to a future which my generation is not privy to. You look at India, you see the future in a manner in which none of us can see it. And therefore, your expectations, your demands, your concerns are of a very different order than what we look at as our concerns and demands and how we expect to meet them. And therefore, I will speak with you, and as in the financial world we say what is underlying is the one thing which I believe we will share, which bridges this generation between mine and yours, is that one thing which is called hope. We live through very difficult times. These are difficult times for everyone in the world, as you would be seeing. You read papers, you come across analysis, you hear people speak with you. These are difficult times not only for India, but these are difficult times for the world at large. We are going through an unprecedented crisis, not because such crises has not happened in the past. There was a Great Depression that you've heard of. But this crisis takes on a completely new shape because today the world is connected in a manner it never was connected before. So when the Great Depression hit, say, United States or hit UK, the contagion which spilled over to the other countries were much less because interconnectedness was very limited. Today, we are a globalized world in more sense than one. We are globalized because not only of the communication, the IT revolution that has brought about this tremendous communication today. You can sit here and on Skype, you can look at the person you're talking to in the United States. Through the television, the whole world streams into your drawing rooms or your bedrooms. You can see what is happening in other parts of the world. When there is an attack in Syria, the chemical attack in Syria, the stock markets in Mumbai tank. There is this interconnectedness which we never lived through before. And then secondly, for countries like India, we have become globalized in a manner that we never were before. Today, our borders are open virtually for capital flows to happen. For people to come in and go out, we have a very fairly open regime. So there is this great movement which happens, both of capital, people, and ideas, which creates this interconnectedness, which also then creates a crisis of a proportion that we have never seen before. Look at what's happening if you look at the underlying principle of today, growth. IMF has 3 times in this year lowered the global growth forecast, 3 times in 1 year. What have they said? They have brought it down from almost a level of 3.9 to 4% to less than 3% in 3 successive declarations. If you look at the growth story in anywhere in the world, you would see the growth story is slowing. China, which used to be the pride of the world in terms of driving the growth machine, has slowed down. From a level of 11%, it came down to 7.5% last year. Where do we stand? We touched a dizzying height, because if many of you who have read economics may have read the great Indian economist Professor Raj Krishnan, who coined the word Hindu rate of growth. The population in India grew at 3.5% and the economy grew at 3.5% year on year on year on year for 4 decades. That was called the Hindu growth of rate. And from that, we jumped to, in 2009-10, we reached almost 10% growth rate. We were fated. That was called the India story. And then we started slowing down. We've slowed down considerably, 5%. But if you look around, is 5% really a bad number in today's world? And that is where we need to see how we are looking at, or what our perspective is. We have a situation where the world has slowed, therefore, we are affected by it in what manner? We are affected in the manner where our exports have slowed down, because exports necessarily have to be sold in a market which is growing. If Japan has grown year on year for less than 0% growth, if US prides itself when it touches 2%, 1.5% growth, if entire Europe has gone through a huge turmoil in the last 5 years where the growth has been 1.5 or less, then 5% doesn't seem like completely out of sync with this. But if you ask me, are we satisfied with it? The answer is absolutely not. We are not satisfied with 5%. We are not satisfied with 5% because the potential growth rate of India is 8%. Not less than 8%. And therefore 5% certainly is not a number that anyone can be happy with. So let me today speak with you about growth in the perspective of what we see as a macroeconomic paradigm before us. And I will try and address some of the issues that you read every day in the newspapers which concern the economy in this country, namely depreciation of rupee, for instance, current account deficit, fiscal deficit, these are the kind of issues that you see, and of course inflation, which affects everyone's life. And all this packet, if you look at together, also then reflects on how the growth will be. So let's start with each one of them and deconstruct each one of them for our own understanding as to how these look today. And then I'll also give you a perspective of what the government is doing to address them. Because I want to assure you that the government is in control of the situation. We are on top of it. It is not as if we don't understand the pitfalls. It is not that we don't understand the dangers of what lies ahead. But we are confident that with whatever levers we have in hand, we should be able to manage it. So let's start with the volatility of the rupee. How does rupee move up and down? There is something called the intrinsic value of the rupee. The intrinsic value of the rupee comes from its purchasing power. So for 1 rupee, what can you buy? But this is never absolute in nature. So make it a purchasing power parity. So in $1, if you could buy X amount of goods, then in the same goods you can buy in a rupee at a particular value, and that becomes the purchasing power parity between the dollar and the rupee, the same amount of goods. So if you look at the purchasing power parity between a dollar and a rupee, you will see it is very different from the value of the rupee that you see in terms of the sale of rupee and dollar. The other way of looking at it is what we call the real effective exchange rate. A real effective exchange rate is when you look at the currencies of our trading partners, and you then, in relation to those currencies of the trading partners, you look at the value of the rupee, then that becomes the real effective exchange rate. In today's terms, if you do that calculation, the intrinsic value in real effective exchange rate for rupee is somewhere between 58 and 60. But then the question that you will ask me is, if that is so, why is it that rupee begins to move in a very strange manner? It went up to 68 to a dollar. Why does it happen that the markets completely go haywire? Now, answer to that is sentiment. You may have heard in the past, many social scientists have said, man is a social animal. I would also say man is a sentimental animal. What happens is that you begin to see a correlation between many things, which are in some manner right also. But that correlation is something which determines your fears, and those fears drive your decisions. So what is the fear that you see? In the context of India, rupee value is determined by one who buys dollars in India, one who buys dollars, and one who sells dollars. It's a commodity. Rupee also is a commodity in a manner of speaking, where you buy and sell. So who buys dollars? The importers buy dollar. You have large imports into this country, and for importing goods from outside, you need dollars. So you go out in the market and you buy dollars. And who sells dollars? The exporters sell dollars because they earn dollars. So they bring dollars into the country and sell dollars, and the importers buy those dollars to import goods from outside. So there is a relationship between them. Now suddenly you see there is a projection that India's current account deficit is going to be $75 billion this year. Now, what is a current account deficit? Current account deficit is the difference between the dollars earned and the dollars spent, which means that your exports are going to be short by $75 billion in relation to your imports into the country. That's the current account deficit. Now, if you have a $75 billion current account deficit, the importers believes that if I do not buy dollar today, 2 months or 3 months down the line when I need the dollar, because there is a huge deficit in the market, therefore the dollar will become dear, become more expensive. So what does the importer do? He goes into the forward market. He goes and buys forward. So there is a market where you can buy forward. So I say, I would require $100,000 in December. So at what value can I buy dollar in December? And there is an exporter who says, I will hold dollar today because there is a current account deficit, there is going to be a shortage of dollars. I will sell when the price is high. You may have heard of hoarding. When we all live in our lives, we feel, why sugar prices who shoot up? Because somebody is hoarding sugar, is not selling in the market, in the hope that when the prices go up, I will sell at a higher rate. Dollar is the same issue. You're hoarding dollar because you believe the price will go up, and therefore you will buy in December. So what happens? I ask for a quote in December, and you are the seller. You tell me, I'm willing to buy dollar. I'm willing to sell you a dollar at 65 rupees to a dollar, even if today the dollar is at 61, because I believe that by December the dollar will become so scarce that the price will become 65. So when December it becomes 65, there is a panic in my mind who's another, I have to buy in January or February. I believe if dollar is going to sell at 65 in December, it is likely to sell at 68 or 69 in March next year. So how do I lock in for my March imports? So I go into the market and say, how much would you pay me, give me a dollar for March? So the seller says, if I can sell at 65 in December, obviously the dollar is going to be dearer in March, I will sell you at 67. And this is how the price of the dollar begins to rise in relation to the rupee. This is one part of it. One part is where there's an actual buying and selling. But then there is another part of it. Young guys like you, when you get out of your MBAs, you do you get good degrees, you go out, some people snap you up. Some of you will go and sit in Singapore and become punters. It's like going to the race horses. So what do? You put a bet on a race horse. You say this race horse is going to win, and I'm going to put 1:10 on this. You become a punter on rupee. You go and say, in March, I believe the rupee will be $70. Do you read these lot of analysis coming out? By December, dollar is going to be 70. By March, it's going to be 90. Do we have a crystal ball? Are we soothsayers? Can we really look into the future and say this is what's going to happen in March? That's not how it happens. It's a punting that you do. And then you become great analysts. So you write in newspapers. I see many journalists here who like these people who write in the newspapers. So they will write, dollar is going to be 70, dollar is going to be 90. You're pushing the sentiment towards that. You're creating the sentiment in the minds of the people to say, dollar is going to be 70, buy now. And that's how the rupee begins to move forward. It goes up. So this is how rupee depreciates. And why does rupee appreciate? So I, as secretary in the government, go out and say, this is irrational sentiment. Those who are punting today will be burnt. They will lose money. Why will they lose money? Because I tell my math to them. There is something called mathematics. There is something called arithmetic. There is something called numbers you add. You can do as much punting as you wish, but the numbers don't change. And what are those numbers? The numbers are as follows. If I have a $75 billion current account, it is on account of one fact, and that one fact is the great fascination of the Indians with gold. Last year, which is till, I'm talking of the fiscal year, till 31st March last year, total production of gold in the world was 2,200 tons. Total purchase in India was 1,000 tons import. So I'm often asked by people, is malnutrition in India? In a lighter vein, is malnutrition in India on account of the fact that Indians prefer to eat gold? After all, 1,000 tons of gold we import in this country. Last year, the bill was $56 billion. If all of us were to collectively lose our fascination with gold, this country would have no current account deficit, virtually. But it doesn't happen that way. So $75 billion is our current account deficit. What did the government do? We raised import duties on gold. We created hurdles. We threw sand in the wheels. And the gold imports started coming down. We said we will save $4 billion in the current account deficit by reducing the gold imports by $4 billion. Not a fantastic number. The number actually is going to be bigger than that. But we, in our in our arithmetic, we took $4 billion reduction. That brought current account deficit to $71 billion. We said there's be a compression in petroleum consumption, and therefore the petroleum products will be imported less by $1 billion. And we have numbers to show, because we don't have time, I will not go into details of this, but we have numbers to show that bulk consumption of diesel is coming down. We will save $1 billion. So the current account deficit is $70 billion. How do you finance this? So we said, if there was no net FII inflow, and what is FII inflow? Is the foreign institutional investors investing in Indian shares and bonds. If there was no net FII flow into the country, if the foreign direct investment, which is investment made by the foreign companies into Indian companies or Indian projects, if the net foreign direct investment in the country remained at last year's level, which is $22 billion, if the exports grew at the rate of last year, then the capital flows into the country will be of the order of $64 billion. Not a fantastic number. It happens. It would happen. So the deficit is $4 billion, between 70 billion and 64 billion actually. So I don't need to find, the importer should not be calculating his purchases or her purchases at $75 billion gap. They should be looking at $4 billion gap. Immediately the mind changes. And then we said we are taking certain steps whereby we will have an additional $11 billion inflow. We did the number, we gave the numbers. Once this came out, immediately there was an understanding in the market that the fears that they were living with were unfounded. But let me give you something more interesting than that. In the last year, in the first quarter, FDI flows in this country were of the order of $5 billion. This year in the first quarter, which is April onwards, the first 4 months from April, the net FDI flow in the country has been $9 billion, which is 70% increase over last year quarter, first quarter over this year first quarter. If that trend continues, last year it was $5 billion roughly every quarter. If this year we get $9 billion every quarter, and I have no doubt that we can, the FDI flow itself will be more than $36 billion, which is $16 billion additional capital flow into the country over the last year. And this is in addition to the $11 billion that we spoke of. But we also did something more than that. We created a new NRI deposit window in which now everyone believes by 30th of November this year, we shall have another additional flow of 15 to $20 billion. Clearly, you are looking at a wall of about $40 billion to meet with any eventuality on account of the current account deficit of $4 billion. Obviously, the fear is irrational. Now look at this. If I continue to maintain the dollar at stable dollar at the level of whatever it is today or a little less, not because of government intervention, not because government wishes to hold dollar at any particular level, but because of the intrinsic value of the rupee, if it remains at that level, what happens to the people who punted higher at 64, 68, 69, 70, sitting in Singapore? In December, they lose money heavily. In March, they lose money heavily. They get burnt. Now, that is where you have to reverse the sentiment. This is exactly what we do. This also links up with the other issue of the quantitative easing. You must have heard about the chairman of Federal Reserve who said that there will be no tapering, but everybody believes in December there will be a tapering. And when there is a tapering, there is again, you must have read today also in the newspapers, people have said, and when the tapering happens, there shall be an outflow of capital and again rupee will be hit. I do believe there may be an outflow of capital. That is quite possible. But the fact also remains that we have sufficient ammunition in our hands. And what is that ammunition? Close to $270 billion of foreign exchange reserves with the Reserve Bank of India. Close to $40 billion of additional inflows in this year of capital. A $50 billion swap arrangement with Japan. $100 billion of contingency reserve arrangement that the BRICS countries are going to sign up. I think we have a wall. And therefore, there is no reason to be fearful of rupee taking a tanking of the nature which doomsday prophecies are making us believe. So that is the first part of my story on the rupee, on the current account deficit. Let's look at the fiscal deficit. Fiscal deficit is when the government spends more than what it earns. So the difference between what it earns and what it spends is the fiscal deficit. What does it mean? It means that government becomes profligate. It spends more. And it spends more by borrowing from the market. So it goes out and borrows money. And how is the money borrowed? All of us put money in the banks. The government goes and buys through bonds what we call the G-Secs or the T-bills, treasury bills. We borrow from the people of India. We borrow with the promise that we will repay with a certain interest rate. But the question is, how much can we really afford? Because when you are spending more than you are earning, you also create, because you are borrowing from the market, you also create inflationary pressures. No government is able to, in developing countries, able to finance its expenditure without some deficit. Some economists believe some deficit financing is also good for the economy. Be it as it may, the question is, we cannot have a runaway deficit. It creates a problem. In the last fiscal, our current account deficit started rising very sharply. In October of 2012, the government received a report from Dr. Vijay Kelkar's committee which said, if it is going to be business as usual, the deficit in the country is going to be of the order of 6.4% of the GDP. Immediately, the credit rating agencies from all over the world began to speak of a sovereign downgrade. A sovereign downgrade means that the risk that an investor will take in investing in a particular country has increased exponentially. And there are different ratings below which, if you go, what is generally in corporate parlance known as the junk grade, then very large number of investors will not invest in that country. there was this imminent fear of sovereign downgrade. The finance minister announced a fiscal consolidation roadmap. How are we going to start compressing the deficit? You cannot obviously do overnight. It has to be a gradual reduction. So he said, in last fiscal, that is 2012-13, we will bring fiscal deficit down to 5.3%. We will continue to reduce it 80 basis points every year to reach 3% by 16-17. Many of my friends who are sitting here, I can see them, they're very familiar from the press. They didn't believe us. They all said this is a pie in the sky. You cannot reduce fiscal deficit to 5.3% from an projected 6.4%. It is more than 100 basis points in 1 year. You cannot raise your revenues in this manner, and no government is going to ever cut its expenditure because that's the populist thing to do. Till February of this year, we were hearing this skepticism. We were hearing there's going to be a downgrade. Nobody was believing us. On 31st March, when the first numbers came out, because of very credible, very determined effort of the government, the fiscal deficit numbers came to be 5.1% and not 5.3%. That was a shocker. But what shocked everyone, including us in the government, to be very honest with you, is when the final numbers came, actually fiscal deficit was 4.9%. In less than 8 months, the government had compressed its expenditure by more than 120 basis points, which meant a reduction of expenditure of more than 1 lakh crores. For the first time, I think everyone believed government means business. There is a credibility to what the government is saying. This year, our target is 4.8%. With the rupee depreciation, our bill, oil bill, other bills have started going up. There is this whole question of subsidies, which I will address shortly, because it's related to fiscal deficit. But the finance minister has said, and I do believe it is going to be so, that there is a red line that has been drawn. And that red line is fiscal deficit in this year shall not cross 4.8%. We'll do whatever is necessary, whatever is required to keep the fiscal deficit at 4.8%. And this brings me also to the question of subsidies. What are the kind of subsidies that we provide, and are they necessary? Because much of the fiscal deficit also happens on account of the subsidies which are given. So the first subsidy that is given is something that you and I also enjoy. That subsidy is the petroleum subsidy. For us, it is reflected in the price of the diesel, which many of us, including myself, use when we are using our vehicles. And the second, it gets translated for us in the price we pay for cooking gas, which we burn in the homes. Today, government is paying, government out of its exchequer is paying for all of us close to 13 rupees per liter in diesel as subsidy. Now that the rupee has strengthened a bit, it is going to come down less. But even if we were to take an average of 10 rupees per liter, next time when you sit in your vehicle, which is if it's a diesel vehicle and you drive, remember for every liter you're burning, government is paying 14 rupees to you. That's one subsidy. On every cylinder, the subsidy is close to 500 rupees. So every time you burn up a cylinder for cooking your meal, remember government is giving you 500 rupees as cash. Now this has been reduced to 9 cylinders a year. But for those 9 cylinders, that's the cash you are getting in your pocket. I leave this to you whether this subsidy is good or bad. And I hope through the day when you are sitting here, you will debate on it. Because I do believe there is no case for subsidy on diesel and gas. We must pay as much as we use. And it should be reflected in the real market price. But let's look at the other part. There are other subsidies that we give. What are the other subsidies that are given? The other subsidies that are given, for instance, food security bill, you must have heard. A lot of debate which is going on whether food security bill should have been brought in a country which is so poor and what are the numbers that you're going to spend on it. People talk of Mahatma Gandhi, Narega. You must have heard of Narega. That there's a huge amount of money, 30,000 crores every year, which is given out as dole to these people who are non-productive, who don't do any work, and we are just creating this huge mass of people which have no skills, nothing. Now let's look at just these two. And then we look at also a little bit of fertilizer subsidy that we give. But let's look at these two first. Food subsidy, today, just the numbers, without food security bill, the government spends on food security close to 80,000 crores. This is being spent today. We are paying this money today to provide cheap food to poor people. When food security bill comes in, the total expenditure will be, before that, we have a midday meal scheme in which we are spending close to 13,000 crores every year. So that together, if you look at it, it is 93,000 crores, which is spent. If food security bill comes in, the total bill to the government will be in the region of 115 to 120,000 crores. That means about 20 to 27,000 crores addition to what we are spending today. So when you read these numbers of 115 and 120,000 crores, please do not be misled that it is an additional expenditure which is required to be done. It is not. The additional expenditure is going to be between 20 to 27,000 crores. That is the additional expenditure, because both these will be subsumed in the food security bill. Now, if you look at the food security bill or you look at Narega, imagine in your mind a European Union. Many of you may have traveled into Europe, and there is this European Union, all the countries which form European Union, where the total population of the people in that European Union is close to 350 million people. Now imagine one European Union in India, which consists of people like you and me. People who sit in air-conditioned halls, who drive air-conditioned cars, who have surpluses to go to eat out, go to the pub in the evening, sometimes go to a jazz bar. People who have cars, many of us who have Honda Accords and are dreaming of BMW 5 Series or some such. This is a one India which lives inside this India, which has aspirations, which have frustrations, which have demands, which have needs of a nature which frustrates them when they see a government seemingly throwing money away on subsidies, on food security, on Narega, etc. But just imagine another thing. In the same India, there exists another European Union of people who are poor, who live at less than $1.5 to $2 a day. Their concerns are existential concerns. Where will my food come from in the evening? Whether my child will get medicine when the child gets sick? If the wife gets pregnant, has to be taken to the hospital. Will the bus come in the day or not come to the village? Will I have to carry her on a cart to the hospital? Will the doctor be there or not? Will the doctor see me because I am in torn clothes? Will the doctor throw me out because I don't have money to pay? These are the concerns of those people. So, this government is for who? Is the government for only one India, which is aspirational India, and should take all the decisions that impact them and their lives and make them happy? Or this government is also for the other India, which is living with existential issues? And should the government also make decisions for that India? And when the decisions are made for that India, this India is unhappy. And when the decisions are made for this India, that India is unhappy. And therefore, there is no satisfaction which is total or complete with the government in any one. But I think it is the way it ought to be. Because if any of these Indias was happy and satisfied with the government, it would mean that the other India is suffering. Decisions need to be taken which would carry everyone together, which will impact everyone's life. We cannot forget those people. And the reason why we cannot forget those people, many times the comparison is done with China, is because we are not a command economy. We are a democracy. People vote. Even people who don't have anything to eat have a vote. They can change governments, which is good, because that is how governments are accountable. So therefore, the government must take care of everyone. And I believe, therefore, that some amount of subsidies would be necessary and are desirable. And to top it all, even governments like United States give subsidies. So let us not be under this illusion that this illness afflicts only us. This is an illness which will afflict any society where there is a differential in the lives of the people. There will be an element of subsidy and we must accept it. Let me very quickly now talk to you about inflation briefly and then growth, because I think we'll then have some time for question answers. Inflation, if you look at inflation today in India, much of it is food inflation. And food inflation is very interesting to look at because food inflation happens in two ways. One, of course, is the demand-supply gap. Demand-supply gap happens because if the consumption levels rise very fast and the supply is not adequate, then you have inflation. In India, to a great extent, it has happened. In rural areas, in the last 5 years, year on year, if you look at the wages increase, they have increased almost 14 to 15% per annum. And therefore, if you look at the companies like ITC or Hindustan Lever or any of these FMCG companies, their sales in rural areas have also grown 14 to 15%, which means that demand is rising. And because that is rising, therefore, consumption levels rise and therefore then the prices rise. That is one function of inflation. So there is a higher food intake, prices become higher. The second part is structural in nature. It is structural in nature because we have what we call a minimum support price regime. And this minimum support price regime is necessary to incentivize the farmer to continue to grow food grain. Because it's very easy to move away from food grain to cash crops because you can make more money. But can you imagine a situation if in India, which has a population of 1.24 billion people today, if we had acute food shortages in this country, how will we buy food for this number of people from anywhere in the world? We have seen in the past when we have a shortage of edible oil in this country, whenever India has gone into the market, the prices, world prices of edible oil have shot up very high, and we become the price takers. So therefore you have to incentivize food, and therefore you have to keep certain incentive for food production, and that also then pushes up the prices of food. So we have a problem of food inflation. But if you look at industrial inflation, it has started coming down drastically. At the last count, it is close to 3.5%, which is fairly low. So we believe as we move forward, this year we are going to have a bumper crop of food grain because the sown area in the country has grown by 9%. And therefore we believe that by Diwali, a little after Diwali when the fresh crop comes in, you will have food inflation come down significantly. So what happens to growth? What we wanted to discuss today. Growth is a function of investment, because we must have investment in the economy for growth to come back. And investment in the economy happens again on sentiment. A lot of people talk about interest rates being very high. But if you look at the real interest rate, which is inflation, interest rate minus the inflation, the real interest rate is very low. So therefore, I do not believe inflation, the interest rate is the only reason why investments don't take place. We have seen, in my time I have seen, interest rates being 18%, 16%, 17%, and investments happening. So investment also happens when sentiment is positive. When the sentiment becomes negative, investments don't happen. So how do you kickstart this virtuous cycle of investment? And for that, government has taken several decisions which we believe will get reflected in the growth numbers as we go ahead. One, there has been a huge backlog on account of slowdown in approval processes in the government. And the slowdown in the approval processes in the government has happened on account of the fact that environment clearances get delayed, land acquisition gets delayed, etc. Last year in December, government set up a cabinet committee on investment, and since January up to May end, it has given approvals, final approvals to projects which were stuck, which total up to $30 billion. We believe that investment in these is now beginning to happen, and we will see in the third and fourth quarter its reflection in the growth numbers that you see. We are also now beginning to see a lot more interest of foreign investors in the Indian economy, as I had given you a number, but you see a slew of new proposals which are coming in, and even in the airline sector you have seen Air Asia coming in, Jet Etihad coming in, and now Singapore Airline with Tatas have also filed an application for approval to set up a new airline. There is now a movement, there is now a sentiment which is coming in for investment, and I do believe going forward you will see, because of the numbers that we have discussed, growth will begin to pick up. But there is also a large number of structural reforms that have taken place, which I believe are going to make an impact. There are a huge number of new townships which will be developed. In the last week, I chaired that committee on the Delhi-Mumbai Industrial Corridor, and we approved projects which total up to about $25 billion for different projects on the Delhi-Mumbai Industrial Corridor. There is now a much greater interest in the in the Chennai-Bangalore Industrial Corridor, where the Japanese are also coming in a very big way to invest. Similarly, we see in Bangalore-Mumbai Industrial Corridor, there is a lot of interest of companies from Germany and companies from UK. And the latest to be added to these corridors is Amritsar-Kolkata corridor, on which work is just started. All these investments are going to come into these areas because we are seeing that happening. We are seeing that interest happening. Then we have two dedicated freight corridors from Kolkata to Delhi and Mumbai to Delhi. These dedicated freight corridors are going to have a total investment of about 1 lakh crores. And these are also now moving very rapidly. Work has already commenced on these. And we believe once this happens, we will have a large number of logistics parks which will come around these dedicated freight corridors, which also then means more investment and therefore more addition to growth numbers. So all in all, we believe moving forward, the growth numbers will come back. 2 to 3 years down the line, we should actually be looking at 8% growth rate. I have no doubt about that. So, how do I conclude? I go back to what I had said first. You see the world, you see India, you see your lives very differently than I see mine, or I see India, or I see the world. But what joins me and you together is only one factor, which is hope. So let us ride on this hope into the future. Let us believe in ourselves. Let us not allow anybody to detract us from that. Because we believe we as a nation have a great future. Thank you.